My name is Michael Ricciardi. I'm the managing partner, co-founder, and head of Mercury Capital Advisors. And Mercury is the sponsor of the Mercury iFunds platform. I'm here today with Henry Bregstein, the global co-chair of financial services at Katten Muchin Rosenman, which is among the preeminent alternative investment law firms in the United States. The reason why we're here is to discuss alternative investment strategies that have a certain measure of tax efficiency. As most folks are aware, alternatives, for the most part, can be relatively tax inefficient. And so what we'd like to do today is discuss certain structures that would lend themselves to efficiencies that would otherwise not be presented with a traditional, if you will, alternative investment. So Henry, welcome.
Thank you.
Nice to see you. So,
thank you for that.
However you'd like to start, sir.
Well, I think the first point to really focus on is what types of alternative investments are tax inefficient. And many of the major strategies have inefficiency. So long-short produces almost all...
Long-short hedge funds.
Long-short hedge funds produce almost all short-term capital gains, which are taxed the same as ordinary income.
Sure.
Very high tax rate. And then lending strategies, credit strategies, which are the focus, both hedge fund and private equity,
sure,
also have tax inefficiency producing ordinary income when we're speaking about a taxable U.S. investor. The other aspects of tax inefficiency are for pension plans and other tax-exempt entities and persons, sure, and there it's leveraged real estate presents difficulties, lending strategies again. So the focus is how can those tax inefficiencies can be overcome or sought to be overcome, and that's where we've worked together with Mercury and Mercury iFunds to develop a strategy to provide access to tax efficiency. And the basic elements of that really go to private placed variable life insurance and annuities, predominantly dealing with private placed variable annuities.
So let me make sure I have it right. So to the extent that a strategy, irrespective of whether it's an alternative investment strategy or not, but to the extent that a strategy is cash flow generative or, let's say, ordinary income generative, as opposed to something that would naturally garner long-term capital gains, those would be the better candidates for these types of structures.
Exactly.
Okay, so give us a sense as to what those structures might look like. What do they comprise?
Well, the structure comprises exposure to a variable annuity, and it's called a privately placed variable annuity, and I'll get to that to a moment.
Also known as PPVA.
Right, and other terms as well. And what a variable annuity is issued by a life insurance company, and it allows for deferral of recognition of income during the investment period, and that investment period can be 5, 10, 15, 20, 30 years. There really is not a limitation.
And this is no different than, quite frankly, the legal structure, if you will, around variable annuities in general, to the extent that here we're talking about the inclusion of alternatives. These strategies already exist within the insurance companies, albeit in most instances less so with alternatives.
Exactly correct. I mean, the basic variable annuity, retail variable annuities, are a huge market in the retail space. Right. They tend to have retail pricing along with being available in the sure, retail space, so they typically have heavy loads and commissions, but can be accessed at very small investment amounts. So sure, there are reasons for it. But in the accessing alternatives, private placed alternatives, hedge funds, private equity funds are privately offered. Sure. So not available to advertise. So that's where the structural differences come to fore. But yes, this is nothing that is cutting edge in any way when it comes to the legal issues surrounding the use of variable annuities. I think that's important.
So from
factor.
An IRS perspective, no issues. This has been around a long time. It passes muster and so forth.
It's been around a long time, certainly. The difference in the private placement space is the private placements were available if you go back 30 years or even 25 years ago. This was entirely an institutional product. And what I mean by that would be corporations buying policies where premiums were 20 million, 30 million, 50 million. I've worked on transactions with banks where a transaction will have a $100 million premium.
Sure.
So this was really an institutional product. It then migrated to large family offices,
Yep.
again, where I wouldn't see a transaction below $25 million. And I've worked on transactions, many, many multiples of that number with very high net worth individuals, family offices.
Sure.
So the difference in the access to variable annuities now for alternatives is putting that access into a form that almost could be used as a idea of a feeder fund access into the alternative investment, into the private equity
just
hedge.
to be specific, this is then something that's not exclusively relegated to the 25 million and up investments from family offices. What would be an acceptable minimum, let's say, for somebody that would contemplate making an investment that would be tax efficient into one of these structures?
Well, I think $100,000.
$100,000.
$100,000.
Okay.
And before really working with Mercury, working with you and your team, the lowest number that you'd really see would be $1 million, at a times maybe $500,000, but it was nothing, dealing with a $100,000 investment because the issues of having to create legal and operational efficiency.
And the loads presumably, or the fee structure, if you will, at $100,000 is, for all intents and purposes, almost right on top of the fee structures that one would incur with a larger family office. It's very efficient in that regard as well.
Right. The product allows for aggregation of investors.
Okay.
So, and it's a simplification for the investor, simplification for the insurance company.
So rather than having $1 million investment that might have to this point in time been an acceptable investment, it's an aggregation of 10 different investors, let's say, that might then comprise that $1 million, and they'd get it at the same pricing, if you will, as somebody that was willing to write a check for $1 million or a $25 million family, effectively.
Well, depending on the tiers,
sure.
I think it would be effectively the $100,000 investor is going to get the same in pricing out of the insurance company as a $5 or $10 million investment.
Okay. And can you talk about other characteristics or attributes of a PPVA, a privately placed variable annuity? What might be the other benefits, if you will, and are there any negatives? Let's first talk about the benefits.
Well, the benefits are, for a taxable individual, really is deferral and compounding of returns.
Is it similar then to somebody's individual retirement account, an IRA on steroids? Well, you don't have a cap, it's an unlimited amount?
It's an unlimited amount. The difference is with an IRA, it's pre-tax dollars up to a limit. Mm-hmm. And here you are taking after-tax dollars. But in a high-tax jurisdiction and a tax-inefficient strategy, the benefits really start showing up in very, very rapidly.
So if we were to compare apples to apples, a Roth IRA over here, and you can only put a certain amount of money each year into a Roth IRA, and again, those are after-tax dollars. And over here, you have a PPVA, which again are after-tax dollars. The growth could be the same if you were in the same exact investments. The difference, if I understand it correctly, is that there is an unlimited amount of money that you could put into this PPVA, and the Roth IRA is limited by the amount of money that you have available on an annual basis to allocate to your individual retirement account.
Well, but the Roth comes out tax-free. The variable annuity is going to be subject to tax.
Okay.
So it really is more equivalent to a standard IRA,
okay.
Where
Understood.
it's going to come out and pay tax,
okay.
all ordinary.
Okay.
But there are other tax advantages as well. Plus, and similar to either IRA, the investor's not picking up a tax return, K-1s, reporting from the investment that can get complex over time.
Okay.
So those are the benefits for.
Now the growth presumably is dramatic to the extent that one were willing to hold on to a particular investment for a longer horizon, 5, 10, 15, 20 years in one of these structures, and we were to compare the after-tax versus the pre-tax being what one would have been if there were in a structure that had different tax characteristics, less tax efficient, presumably one would get all of that growth because one is not paying the tax every year on the income as it's generated in a traditional alternative investment.
If the investment produces a return,
Yeah. Okay.
then the difference can be dramatic. Clearly, the longer period of time, the better. And for clarity, the investor doesn't have to maintain exposure to one particular investment, strategy, or fund.
Okay.
So there's the ability to select different investments over time from investments that are made available by the various insurance companies.
Now, is this set up in a separate account of the insurance company?
Well, the question is, what's a separate account? I think the question is, and I think it's certainly a really relevant, important issue, is what is the risk? What's the additional risk to the investor in investing through an insurance company rather than directly into a fund? And the risk is minimal because even if the insurance company became insolvent, these products, the value of this variable annuity contracts are not exposed to the general liabilities of the insurance company.
So let's make sure we understand that. If one were invested in a traditional whole life insurance policy, which we all know have dramatic premiums associated with them, as opposed to here where there's a very, very skinny slice, if you will. If one were invested in the general account of the firm, of the insurance company, if the insurance company were to become insolvent, are you protected if you are in the general account of the firm, of the insurance company?
You're not.
You're not.
Right.
And here, presumably, then you're bankruptcy remote.
You're insolvency remote, bankruptcy remote when it comes to the assets.
So even if you didn't happen to have the good fortune, or if you picked a AAA insurer, and I understand that this product the insurer is already selected for you, but to the extent that the insurer was not a AAA insurer, the insurer became insolvent, the assets that one had invested in the PPVA would still be protected.
Correct.
Okay.
And the insurance companies that are predominantly involved in issuing these types of policies don't do regular life insurance business.
Sure.
So as a result, it's very difficult for them to imagine actually a scenario where they become insolvent.
Okay.
Because insolvency really relates to an insurance company promising a guaranteed return or unexpected deaths.
Any negatives that we should contemplate that we haven't already discussed?
Well, there's an excise tax if someone, individual, withdraws before 59 and a half from PPVA.
So let's understand that.
Which again is the same thing that you have with an IRA. It's
right,
exactly the same, apples to apples, exactly the same thing.
So if I'm a 45, 50-year-old investor, I make an investment into one of the PPVA structures, I put $100,000 in, and I decide in a year or two or three, I want to withdraw my money. I withdraw the money, I pay ordinary income to the extent that there are gains, and then I pay a tax on top of that as well. 10%
excise tax, just on the gain portion.
Okay, and so would that then suggest to you that the product might be better suited for folks that are already above 59 and a half?
No, I wouldn't think so.
Okay.
Because you'd want to invest over a longer period of time.
Okay.
So it's the same concept, theory, philosophy, strategy as behind putting money into an IRA, 401k. There's just the flexibility of investment. Ability to diversify out of investments that would be typically available in an IRA, 401k.
Okay, so to the extent then that I'm in a PPVA investment and I don't like the way the investment's moving, I don't like where it's going, and I want to move out of that, to the extent that I move out of that PPVA investment into another PPVA investment, no 10% tax?
No tax at all.
Okay, very good. Okay. So it just has to stay in the structure.
It has to stay within
You're not
the structure.
locked into,
Correct.
other than whatever the underlying lockup happens to be for the funds in which you're invested, you're not locked into having to stay obligated to that fund. You can move in and out.
You can move in and out.
Okay.
Again,
so there's flexibility.
Flexibility with respect to the offerings that are made available by the insurance companies, and what is happening in the with increase of taxes and belief that marginal rates are going to go up and deductions go down, we're seeing managers coming into this space on an accelerated path.
Okay. And can you give us a sense then as to other products that might exist in the market under the nomenclature of tax-efficient alternatives that you think would be equally compelling, if any?
I think there's nothing as compelling as this that serves this function. There are managers that seek tax efficiency, that manage for more long-term capital gain. And that's something an investor needs to look at, is
Okay.
comparing, which strategy is really appropriate for PPVA, and and looking at that.
Okay, so let's just take this one step further now. Let's assume that I like this structure. I'm not comfortable necessarily paying tax upon the liquidation of my investment or in the PPVA structure. Are there any other structures that exist, that are life insurance related, if you will, that aren't necessarily being offered directly on the iFunds platform that may make sense for folks, some form of variable private placement life insurance?
Certainly. And
so just a quick snippet.
So the quick snippet is that a variable annuity, although it'll say there's a death benefit, there actually isn't a death benefit. The death benefit is just the value of the account. And think about it as the value of the investment in the private equity, a hedge fund, minus minor expenses. So death benefit just equals the cash surrender value,
right,
is the term. In life insurance, the cost of the fees surrounding life insurance are higher.
Mm-hmm. Because you're buying the life insurance.
But because there really is real life insurance, a real death benefit, that unless you get to be 99 or whatever the age is, there's going to be a difference between the cash surrender value, the value of that hedge fund P investment, and what the owner or beneficiary of the policy is going to get on death.
Okay.
And at that point, there is no income tax at death.
Okay.
So the income that has the gains that have been sheltered, together with the difference, the actual death benefit component, are paid out at death, income tax free.
Okay. To the extent, and I just want to go just down this path just a bit longer, to the extent that one decided to make, and presumably would be an increment that's in excess of $100,000, an investment in private placement life insurance, what would be a normal threshold for an investment, minimum threshold for a family office to contemplate doing this?
$1 million.
Let's say $1 million minimum.
Really would be the barest minimum.
Okay, so let's say $1 million minimum from a family office. That family office, let's assume over time, decides that they want to take some of the money out of their cash surrender value. They want to withdraw some. Now, I understand that in the PPVA, if they take money out, they're going to pay tax, ordinary income. You cannot necessarily borrow against that, but you can borrow against a life insurance policy.
Structured in particular ways. Not all life insurance policies, but you can borrow out of certain life insurance policies.
And in this circumstance, it can be structured in such a way that were one to borrow, they wouldn't necessarily be paying the tax. The same way if I had a whole life policy, I could borrow against the cash surrender value of my policy that's retained or maintained in the general account.
Correct.
Okay.
Then at death, so long as you don't borrow out too much, the policy stays in place. Death benefit is paid out minus the amount of the loan.
And so folks, Mercury offers on its iFunds platform PPVA. To the extent that people have an interest in PPLI, we would ask that you contact us directly. Those tickets, again, are larger tickets, $1 million and up. I know Henry's done transactions north of $100 million of premium and so forth. Henry would be happy to take you very deep into the product, and to the extent that you have outside counsel of your own that you would contemplate working with, by all means do so. We have access to the appropriate product that would be a good fit. Henry, anything we might have missed?
Well, I think it's just how can an advisor or other user, family office coming on to the Mercury iFunds site access PPVA. It's not as if Mercury iFunds is selling PPVA, rather the access is through something called a tax-efficient fund structure, where the advisor or the client is making an investment in a specifically tailored fund that provides exposure to variable annuities and does that. That's the way that you can get down to $100,000.
And for tax purposes, presumably, that fund is only available to people that are making a PPVA investment.
Correct.
It's not generally available to the alternative investments investors, only to those who are contemplating PPVA.
That is correct, yep.
Okay, wonderful. Anything else? Okay, so we're here with Henry Bregstein. We'd like to thank him for his time. Appreciate it, Henry. Always a pleasure.
Thank
Good to
you.
see you, buddy.